Alrighty, check, radio check. I want to welcome everybody to the call. It's been a couple of weeks since I've done these. I was away, for those of you that don't know, on a greatly needed, long overdue vacation, but I got to spend some quality time with my girls, and it was really, really nice. For those of you that have never been to Hawaii, I would strongly encourage you to think about it, especially after an 18-month quarantine. The island we were on Maui, and it's been opening up. And so it was good, it was relaxing, it was serene, and I really made a conscious effort to unplug, not check emails or take phone calls while I was there. I was quasi-successful, but it's still a challenge. Before we get started, I got some disturbing news while I was away, and the reason I share this is because, I have a variety of interests, but one of my long-term interests has always been, and I feel compelled to share, is martial arts. I've been teaching and training women's self-defense for a long time. I am currently and actively re-engaged in martial arts on multiple levels. And I've been introduced to a martial art that I was not really familiar with. It's called Wing Chun. I got stimulated by it by watching the History Channel, and there was an episode of the Kung Fu Nun and how she, 500 years ago was being persecuted and learned some of the arts. And the reason I share that is I found an instructor down in South Jersey, and as I've been going, we've started doing knife fighting and training. And I was like, I never really, in all my years, I've practiced with some weapons, but never really been taught how to use or protect myself against a knife, right? We all hear about guns and gun trainings, and New Jersey's not Second Amendment friendly, and that's a different topic. But, when it comes to knife training, the reason this is relevant is because while I was on vacation, one of my advisors, a lot of you know that I have advisors across the country. They're welcome on these calls. We're part of a group called the Eagle Team. This is a shirt. We're like-minded, holistic in our approach. And I received notice that he was killed. And I'm just my mouth has hit the floor. And not only was he killed, he was stabbed. He was attacked in Denver, Colorado, 65 years old, dead, game over. Times have changed, folks, and no matter where you are in your life, you can't learn less. And I just implore you to A, hug the ones that you're with, B, have a presence of mind of where you're at, what your surrounding is, and what would you do if you're in a situation. I mean, and like I said, I'm a practitioner for 30 years and I never really trained. And the more I've been working with the knife, I realized I had no clue. I had absolutely zero clue what to do or how to react or what to expect. So I know this is not why you tuned in for this call. I just wanted to share that with you because, again, I genuinely care about my clients, my family, everybody that I know or knows me knows that I'm just not your traditional advisor. I'm a person that is a realist, I'm a pragmatist, and I just want to make sure, keep you and your family safe. Make sure that you're able to go home at night. Lock your doors, double check the locks, make sure you have a 911 plan. But if you're in a situation, or if you trust your instincts, if something doesn't smell or seem right, put yourself in a position of high probability of success. All right, so enough somber news. Let's get on. This is called our weekly chat with Chris. It's a June market recap. Now, what you'll notice about this as we go through this is that it's for May and we're in July, and you're like, Chris, you're late. But part of this is, remember that we're always using a lagging indicators, that we're looking at data that is a little bit of a Monday morning quarterback approach, right? Because we're inundated with data real time and we can't always tell how to discern that data. But what this snapshots allow us to do is to sort of take a step back and see where trends are heading. What are we looking at when we see more at a macro level of the data? Now, the first part of this is the equities section. If you've not been on this call before, we have some different color lines here I'm going to take you through, but this is a snapshot of the month of May. So in this period of time, right? Who won the month? And, I'm going to go through this month pretty quickly just because it is only a month, right? Just like a day is only a day. We can't put too much weight into the information. But let's take on the next slide, we're going to see it as it relates year to date. And we just crossed over the halfway point for the year. So what are the signals telling us on a go forward basis? So on this chart, right, the trend has been gold, right? So that is significant, meaning that if you've been following along for the rest of the year, we've seen a little bit of a exodus from the gold marketplace. Last year, it was all the rave, the safety, the concerns, and here it popped its head back up in May. The next line down, the teal colored line, right, at 3.5% is your developed countries, your European countries. So that's good news, meaning that a lot of the European countries are feeling that they're able to get back to work, and now that COVID seems to be under somewhat of control. And I know we have news every day, the Delta variant and all that stuff. And I know I can't speak to it. All I can say is that the data shows us that people are wanting to get back to some semblance of normalcy. Next in line was commodities, which I think is interesting, right? Because last year it got clobbered. And you're going to see on an annual basis, maybe a little bit of a rebound. And then the next two lines, we have real estate, right, is the black line, and the red line is the S&P 500 for the month. But for the whole month, everything in the equities was up, right? Even small caps, right? So that is good news. But as we look at it from a bit more macro level, right, now we see that the teal line, right, that light blue commodities for the year. And again, that makes sense because oil had been pummeled all of last year. And I was just listening in the truck today that oil and now that we're really making it difficult for the United States to produce oil, yet we're giving a go ahead to other countries to say, hey, go ahead and supply it. That's one area. And the commodity indicators or the index here is heavily oil weighted. But also, maybe some of you have heard in the news that lumber is up, right? Inflation is starting to rear its head. So some of this stuff makes sense as to why we're seeing this area such a profitable equity play. Now, the next is real estate. I was a little surprised, but real estate did get pummeled last year. It's still been on an upward trend. I'm not as familiar with this index as to how much of this is individually owned real estate versus commercial real estate, right? REITs and things of that nature. My instincts tell me, and anybody that I think you talk to that is leaving New Jersey is getting a premium for their house. They're getting houses are on the market for 1, 2, 3 days, right? They're getting multiple offers above asking price, right? It is a seller's market. So that part I am absolutely convinced from a real estate perspective, and from me just seeing what's going on around me makes sense, right? Because people are trying to take while the getting's good, right? Let's find a more friendly environment to retire in. Where I'm a little less comfortable is in the commercial real estate, right? Because there's been so many people that have defaulted on leases, rents, things in commercial buildings. So again, the data dictates otherwise, so right now, real estate seems to be a play. I'll be watching that. But I am glad to see that the blue line is 3rd at 15%, which is the blue chips, right? Blue chips and small business owners. I'm always a champion for the small business owner, right? That the person that is going into that chiropractic office, the dental office, your smaller firms, day in and day out, has weathered the storm, has made it through the troubling year that we had in 2020. It has now seems to be getting their feet back under them. Now, with that said, the number one complaint that I hear is they can't get good employees. I got a buddy of mine that owns a landscaping company in Branchburg, had 25 years, has a crew of 20 people, cannot get employees to work for him. He's basically had to shave off 25% to 50% of his existing client base, right? To basically be able to manage the workflow. So, hiring and retaining quality employees, you'll see a lot of the jobs numbers come out, but I do think it's skewed, right? I think that, it is still hard for the small business owner to be able to maintain, attract, and retain existing employees. So keep an eye on that. And then again, red is the S&P 500. We're all familiar, all-time highs. It keeps hitting higher highs. And I'm optimistic, right? I'm still optimistic going into the fall that we will continue to see things move in an upward trend. Now, could things go awry? Yes. Could some global event cause things to go off course? Yes. But I think you'll see on the next slide that right now we still have clear signals, and again, that's just based on what I'm seeing. The teal again, developed countries means Europe is following up or recovering, and so all good data so far for the year. Emerging markets, that's China, your Indonesias, your less developed countries. And then lastly, you see the commodities. So, what's I think significant there is that gold, which, for the most part of 2021, people had lost people that were invested in gold, lost value, but now it's starting to see a flight to safety. So that's a signal that there's some uncertainty on a go-forward basis as to where people should be putting their money on a safe play. All right, so when we see the next slide, we have the bull bear indicator in the S&P, and I know there's a lot going on here. If you've been on this call before, you're familiar. Red lines mean on a vertical basis means that those three triggers have been hit, and it signifies what could happen is a downward trend in the market. From left to right, we have red, then we have green, then we have a red, green, we have a red, a green. And so we have these periods of time over the last 20 years of where signals, which now from top to bottom, we have the top half, which is your moving average indicator. Then we have our relative strength index, and then we have our MACD. And right now you see our last line was a green line. And so, that still is indicating all signals. As much as we've had some recent volatility, we are still seeing positive signs in the marketplace on a go-forward basis. So we watch this. Again, this is a month late data. We have started to see right now, if you listen to the news or watch any of the market channels, there's been some volatility of late. So we'll continue to keep our pulse on this. But if you just take a breath, stop watching the news, and just think about things logically. As your portfolio in retirement, that on a comfort level, my client's advice right now is maintain. But if we see anything that we're concerned about, we don't like to take knee-jerk or emotional reactions. That's where we are for the equities. So let's look at, and as we enter into retirement, what does that mean for income? And then remember, retirement is about income, right? We will have to make sure that whenever we shut off our ability to earn money, that whatever we've accumulated is able to generate funds for us, right? To last us for 20, 30, 40 years, however long we're on this planet, right? That we've created an income stream to maintain a lifestyle that we desire, right? So that's the differences. And traditionally in financial planning and in investment planning, that we want to take less risk as we head into retirement. And I, ad nauseum, during the earlier part of this year, did a breakout segment on investing and whether it be, just how equities work, what equities meant, what income strategies were available, the hunt for yield, and then, some different strategies. But if we're following traditional wisdom, which is, all right, we're going to take less risk. So instead of being 100% in the stock market, maybe a 30-year-old might feel comfortable being 70-30, right? Because they have a long time horizon. But as we approach, retirement, right, we can't afford to have our portfolios lose 50%, right? So the strategies of the past have been, let's take our risk off the table and let's heavily weight the income side, the bonds section. But we've talked recently that bonds, and you're going to see that most of what you see here are all bonds, are challenged going on a go-forward basis. But just on a snapshot of May, we're going to look at that, hey, how have bonds in general done? Well, on a short-term basis, we can see that high yield muni bonds were the play of the month. But let's look at the return for a 1 month basis, barely 1%. That's the challenge. So if you take $1 million and your portfolio was able to only get 1%, that's $10,000. So is that enough to live on? I don't know. That's every person is individualized, but that's the thought process on how, if everybody in the entire world is looking for yield, how do we generate it? And you'll see now it's just on a downward spiral, right? So you got 7-year treasuries, which is safe money. That's akin to gold, right? We got the black line is just traditional muni bonds, U.S. munis, right? Then you have the U.S. aggregate bond play. Then you have high yield corporate bonds. So think about whenever you see the word high yield, substitute the word high yield for junk. Don't need to be a rocket scientist to understand junk means higher risk, right? So if we're trying to take less risk, why are we looking to high yield? That's because there's no other alternatives, right? And then you have your total international bonds. But everything for the month was either at 0 or above. So on a month snapshot, you go, okay, pretty good. But when we pull out and we look at, okay, how did things look for year to date? Well, not as necessarily as good news, right? So now we're back to I'm going to call that I'm colorblind, so, or at least my eyes are fading. But the top line, 3.5% yield to date, still high yield muni bonds. So high yield muni bonds are traditionally going to be for high net worth individuals. Muni bonds are traditionally, from a financial planning perspective, only to be offered to people with $1 million plus, right? Think about it. The reason that they're advantageous is because they're typically income tax free and federally, and then depending on the state as well. So if you're in a high tax bracket, that could be a play. But that doesn't fit the majority of Americans. So high yield muni bonds aren't necessarily the place to go. And again, still a little bit of risk there. It doesn't mean they're risk free. Then we're back to high yield corporate bonds and little over 1%. Again, this is year to date, the hunt for yield. I mean, we're starting to see this trend in upward pressure on interest rates, inflation, things of that nature. But we need to start to think about bond alternatives, right? So we can't have all of our eggs in one basket. I've talked about that. That would be all in equities. But we also can't be in a place where we're getting negative returns, which you see on the bottom half of the portfolio, right? So what's to do? And this is where just, as much as people think that they can do it themselves, or maybe I just took over a portfolio where, an advisor just had them in a plethora of risks. And I did an analysis, an in-depth risk analysis of all their holdings. And I said, look, this might have been fine while you were working, but you're retiring in 2 months. The amount of risk, highly questionable in my professional opinion. And that person agreed. And so now we have to develop, and it's okay to get a second opinion on what you're currently doing. And quite often at the corporate level, right, if you have your 401k and they offer these dial-ins, 40% in bonds, or we've talked about them in the past, target date funds, and they're sort of automated, that, there's no real thought being given to an overall, I think, strategy. And every person on this call needs to have their own individualized strategy. You cannot use a size 9 for everybody. You need to understand, A, what you got, B, where you're trying to get to, and C, develop a course or a plan to go, right? That is just prudent. Yet everybody's looking for shortcuts, right? And I've said this in the past, and I haven't said it recently, and I said most people will spend more time planning for a 2-week vacation than they do for planning for 30 years in retirement. And it shouldn't be the case. With technology today, with the professionalism that is available today, we implore you to get a second opinion. But as you look at this year to date, right, you see the hunt for yield. I've been talking about this all year, is still prevalent, right? That people are looking for bond alternatives. So we need to explore options. When we look at our bull bear indicator for the aggregate bond, I had talked about last month, we were pretty close to having a red line, not there yet. It's still right there. So, it's in this gray area, right? The sky's not falling, right? So it's not a panic driven suggestion. It's just strategic advice, all right? What's the best course to get out of the way of harm's way if we can? So I like these slides just to be able to provide insight, even though it's a month overdue, right? Because it is May. June got away from us because I turned around and I didn't go on vacation. And then we'll be back up to speed. But I think it is still helpful to sort of say, hey, how do I feel about where we're heading, right? And now when you take this data compared to where we are currently, should we make any adjustments to our portfolio? So that's the goal and the strategy. Lastly, we have it's called the Recession Probability Analytics calculator or index that they created. Is proprietary. This is up for the month of June. No alarm. That black line in the middle of the page is a 50. And so as long as we're below that, what it's basically saying, out of 100 pieces of data, right, everything from gross domestic product sales to just income revenue to housing, unemployment, it takes all this data and it assigns values. If the values get above the 50 percentile here, it means that a recession is likely on the horizon. Right now, we've been on a downward trend. It's only now where it started to bounce. Okay, we're watching. Doesn't mean the sky's falling. It just says, hey, listen, heads up. There could be some storm clouds. And this is why I will continue to say it's the third quarter as we enter back into September of this year. So when we get through the summer, obviously I'm going to be doing these calls every week. Once a month, I'm going to do a market update. But as we look at the future, I will start to pay a little closer attention to the signals that we're seeing come the fall. I want to thank everybody for taking time out of their busy schedules to sit with me, to listen to me every week. It's my pleasure to be able to provide this. I value each and every one of you, whether you've spoken to me or not, the advisors that are on the call, the advisors' clients. If you have any questions, please feel free to reach out. And the other thing is, I don't know what my topic's going to be next week. I am back from vacation, so I'll be working on that this weekend, next weekend. But, don't keep us a secret. If we can help you, if we can answer any questions, if you want a second opinion, reach out. All right, that's what we're here for. Each and every one of us, part of the Eagle team, producer partners, these are my partners and my advisors. We're all like-minded, nationwide network. And again, we're here to help. So I want to thank each and every one of you. Have a great day. Hope you all had a happy and safe 4th of July. And I'll see you next week. Bye-bye.